Right, good afternoon, grade 12s. The lesson for today is the impact of 4 forms of investment. Right, so yesterday's lesson we looked at many different forms of investments together with their risk factors, but now we are only going to look at the impact of 4 of those. Now, that is all that the exam guideline requires of us. All right, so what we're going to look at today is we're going to take 4 of those forms of investments that we looked at yesterday, and we are going to look at their impact. Now, remember, impact refers to advantages and disadvantages. Right, so the first one that we are going to look at is the RSA Retail Savings Bond. It's the last one that we spoke about yesterday. Right, if we look at the advantages, as I said yesterday, the returns on the investment is guaranteed. All right, remember when you buy the government bonds, you buy at a fixed interest rate. All right, so for the entire investment period, so if you've bought this bond for 5 years, for 5 years your interest rate is going to stay the same. So for 5 years, remember every 6 months you are going to receive your interest, which is fixed. It is not dependable on the market. If interest rates are decreasing like they are now, your interest rate is going to stay high because that is what it is. It's a fixed interest rate. So you are guaranteed of an interest rate. It's a steady income. It's not going to change. Right, interest rates is market related and attract more investors. Okay, so what I mean there is that when you buy the bond, that interest rate that they fix, that fixed interest rate that they decide on when you make this investment will be a market related interest rate. Okay, so it's related to what the market is doing at the time of buying the bond. But obviously after that, for the 5 years or whatever that you invest this money for, that rate will be fixed. All right, so once the agreement has been reached, it will not be affected by the market anymore. But at the time when you buy the bond, it is market related, which means that it is a favorable interest rate. It's going to attract more investors. A higher type of interest rate is going to attract the investors. It is based on what is happening at that moment. Right, interest are earned twice a year. With all the other forms of investment, interest is earned only once a year. And your interest is paid out to you once a year. But with the retail savings bonds, remember we said you get in September and I think it was March, right? Yeah, February, March, I can't remember now. Right, so interest is earned twice a year, not just once. And interest is normally higher than on a fixed deposit. Okay, remember we said safe investments normally have lower returns on investment. Okay, but your fixed deposits and your savings bonds, the risk is around about equal. I would say the retail savings bonds is a little bit safer even than a fixed deposit, but the interest rate that the government offers you is higher than what the banks would offer you for a fixed deposit. Right, retail bonds are also listed on the JSE. Okay, so it's easy for you to buy them if it's listed on the JSE. Okay, and as I said, it is low risk. As I explained yesterday, it is money that is invested with the government. The government cannot be liquidated. The government cannot disappear. The government cannot go out of business. The government is a fixed entity. They are there. They are always going to be there. So whoever, if they owe you money, you're going to get your money back. You are guaranteed that you are going to get your money back. The government can't go out of business. Right, there's no costs or commissions payable on this type of investment. Okay, so if you think back to, for example, the managed portfolio or the unit trusts or whatever, or buying shares to work through a broker, there's always a fee. When you deposit with a bank, there's always bank fees. But with the savings bonds, there are no fees available. There's no commission that you have to pay to anybody. There's no hidden costs in this type of investment. The money that you give them is the money that you are going to get back. That's what is what they're going to invest. Right, it's easily accessible because cash may be withdrawn after 12 months. Okay, so it's relatively liquid. All right, because once you have, even if you've invested the money for 5 years, if you want to withdraw some money after 12 months, you have to wait 12 months, but then you are able to actually withdraw some of your money. You don't have to wait for the full 5 years or 2 years or whatever the agreement was initially. All right, so it is more liquid than a fixed investment, for example, a fixed deposit. Right, it is affordable for all levels of income earners, including pensioners. As I said yesterday, pensioners like to invest in savings bonds because the interest is slightly higher than on a fixed deposit and it is safe. Pensioners they don't like taking risks because they don't have time to make up that money again. All right, so it's very affordable. The minimum amount of that you can invest is, I think, 1,000 rand. Okay, so it's still a lot of money, but it's more affordable than other sources, other investments. All right. As I said earlier, it's conveniently obtained. Okay, you can buy them electronically. Okay, so on the internet, in other words, or you can buy them at any post office or directly from the National Treasury. Okay, easiest would obviously be electronically or from the post office. And then lastly, investors younger than 18 years may invest, but with the help of a legal guardian. All right. Maybe if you're under 18, you can't buy a savings bonds unless you are assisted by your legal guardian who gives permission. And this means that we are encouraging savings from a very young age. We're encouraging people to save from when they are very young. Right, on the disadvantage side, we did mention yesterday that retail bonds cannot be ceded to banks. So it cannot be used as security to obtain a loan. So if you want to take out a loan and the bank wants security, you are going to need some other form of investment to give them as security. You cannot use your savings bonds. Right, I mentioned already earlier a minimum of 1,000 rand must be invested, okay, which might be difficult for some really small investors. Now, 1,000 rand is a lot of money. If you're not earning loads of money, 1,000 rand is a lot of money to now invest and not be able to use. Okay, so it is a lot of money. Retail bonds are not freely transferable, so I cannot sell my retail bonds to somebody else. Okay, I buy them from the government, and the government will buy them back from me. We cannot just buy and sell retail bonds randomly, right, between investors. I buy them from the government, and the government buys them back from me. That's all. Okay, then very important, this is a form of investment that is only available to South African citizens. Okay, so you must have a valid South African identification document. You must be a South African citizen. So this discourages basically foreign investments, because foreigners cannot invest in this way. They can invest in other ways, but they cannot buy savings bonds. So it doesn't bring in foreign investments. Okay, and then I said that it's easily obtainable and accessible. If you deposit this money, if you make this investment, you have to leave it there for 12 months. And after that, obviously, it's liquid. But if you do need to make a very early withdrawal before that first 12 months is over, they do charge you a penalty. The requirement is that that money stays there for at least 12 months. But if you are desperate, in a desperate situation, and you do need to get your money out, you can, but they will penalize you. There will be a penalty fee, so you will not get all of your money back. Right, if we go to the unit trusts quickly, that's the second one that we're going to look at today. In terms of the advantages, as I said yesterday, it is managed by a fund manager. And because it's managed by a fund manager, the fund manager will obviously know what he's doing. He's a knowledgeable, trained person. He knows how to read the markets. He knows how to make clever investments. All right. So your fund manager, the person that you appoint, is going to buy shares on your behalf on the JSE. So you don't have to think, oh, which shares am I going to buy? Which shares is a good option to buy? You give your money to the fund manager and he will buy the shares. He knows which shares to go and invest in. He's more knowledgeable than what we are. Right, it's also easy to cash in when the investor needs money. All you need to do is let your fund manager know that you would like to get your money back. He will quickly move the money around. He will sell the shares that he has bought with your money and he will give you your money back. Okay, so it's a liquid investment. In the case of emergency, you will be able to get your money out relatively quickly. Right, also a small amount can be invested per month. You don't have to have a large amount. Remember, I said yesterday, every month you give them a little bit. The next month you give him a little bit more, and he keeps adding that to your unit trust. Now he buys more and more shares for you every month when you give him more money. So you don't have to start with a very large amount. You can start with a smaller amount, and over time, the value of your investment will get bigger. All right, generally it beats inflation over the medium or the long term. In other words, what this means is your return on investment, the growth in the value of your unit trusts it increases at a faster rate than inflation. All right. So if the inflation rate is 6%, that means that basically the return on your investment will be more than 6%. If it beats inflation, it grows faster than inflation. All right. Which is good, né? Because if you take your money out, you want your money to be worth something. Okay, you want to be able to buy goods and services with your money. And if it doesn't grow, that's not going to be the case. Right, it is also relatively safe investments to make. As I said, because it is your money is managed by a fund manager that is knowledgeable and skilled and knows how to read the markets. And it's also managed according to strict rules and regulations. Now, there are certain very strict rules as to what is allowed to happen and what is not allowed to happen. All right, so it is very, very strictly regulated, which also makes it safe. Now, that everybody can't just do what they please. Right, your investor also has a variety to choose from. Because you are going to invest your money in shares, obviously there's lots and lots and lots of different shares available on the market. Some shares obviously carry a lower risk, some shares are carrying a higher risk. Your low risk shares will be cheaper, okay, to buy necessarily, okay. The higher degree of risk, obviously, it's not guaranteed that the value of those shares are going to go up or whatever, right? Low risk shares will be shares in a company that is doing well, okay? Shares that is doing well, or a company that's doing well, it's been profitable, it has declared dividends, right? But obviously those shares will be more expensive. Where there's a higher degree of risk, it will be in companies that might be new, they haven't proven themselves, their track record isn't so good, they might not be making so much profit, they might have made a loss over the last 5 years or so, right? That is obviously a bigger risk, okay? And they might be actually cheaper to buy, because it's a risk and nobody wants to buy them. Right, it's easy to invest in. As I said, you go to a fund manager, there's recognized companies, they're like Sanlam, like Old Mutual, they will sell unit trusts. So you can fill in the forms when you go to them. If you go to Sanlam or you go to Old Mutual, they will give you the forms to fill in. You'll sign, all the relevant forms appointing a person as your fund manager, or you can do it online. You don't have to even go into the bank nowadays. Right, fluctuations in unit trust rates of return is not as severe because of the diversity of the investment fund. You are not just investing in shares in one company, you are investing in multiple different shares of multiple different companies. So the risk is spread and the fluctuations is not as severe because your investment fund is diverse. So if some of the shares that you have invested in, the value falls, not all the shares value is going to fall. If some of them falls, some of the others might have increased and it will cancel each other out. Okay, so the up and down of the value of your investment is not going to be as much. Right, unit trusts also provide competitive returns in the form of capital growth. So in other words, the value of your investment grows. Okay, so the value of the shares that you have bought increases over time because if your fund manager obviously is clever and invests in the right things. But if you leave it in the medium to long term, the value of your shares will increase, plus you get the dividends as well. If those businesses who you own shares in, if they do make a profit and they do declare a dividend, you are entitled to receive those dividends as well. So not only does the value of your investment itself, your capital amount grows, but also you are receiving dividends, which is that passive income that we spoke about the other day. Right, I've mentioned this one already. Now I spoke about your fund manager being knowledgeable and trustworthy and what. Okay, on the disadvantage side, share prices may fluctuate. We did talk about the shares yesterday, and I did say that shares are very volatile. Now, in a couple of hours, share values can shoot up into the sky or they can fall down into the dumps. Anything is possible with shares, all right? But remember, with unit trusts, you are not only investing in one company's shares, your risk is spread. All right, unit trusts are also not allowed to borrow, so they reduce your potential returns. Okay, so unit trust, the companies that manage the unit trust for you, they are not allowed to borrow. Okay, so they cannot borrow to increase the size of the investment, to increase the possible returns. Then they are limited to the amount that they actually have. It's not good for people who want to invest for a shorter period, simply because your capital growth is not going to be big in the shorter period. Your unit trust is more suitable for the medium or the long term. so that your portfolio has a chance, the value of your portfolio has a chance to actually increase. Okay, you can totally buy unit trust and then sell them. Okay, you can do that, but it would not have shown very much growth in the shorter period of time. Okay, the growth would be very limited. It could have actually lost value in the short term. That also happens. Right, it's better for long-term investments. Okay, then it's also not good for people who want to avoid risk at all cost. All right, there is a risk involved, okay, but we did say, all of your eggs is not in one basket. You are investing in different shares of different companies, and some high-risk shares and some low-risk shares. But if you are the kind of person that wants to avoid any and all risk at all cost, then this kind of investment is not for you. There are some risks involved. It's shares. There's always a risk. Right, if blue chip companies do not continue on their growth path, obviously the growth of the unit trust will also not render the expected returns. Now, your blue chip companies, blue chip shares are those shares that is expected to do really well. All right. In other words, it is those companies that realize big profits and they give out big dividend payouts. So if you have invested some of your money in blue chip shares, you are expecting that there will be capital growth, okay, that the value of your shares is going to increase over time. Plus, you are also assuming that you are going to be receiving a big dividend payout. But even those blue chip companies, any company at any given time can take a dip, right? If there's one bad business decision or the economy goes into a recession or the company gets into the news, gets some bad publicity or whatever, any company can make a loss. All right. So if you've invested in this blue chip company with this expectation of making all this money, that can also go south. If something happens with that business and it doesn't do as well as expected, your investment is also not going to perform as well as expected. Right, now, very important risk, and this is a risk with any shares. The ask price exists with a price that you can buy. All right, the price that you buy these shares for is normally higher than the price that you can sell it for at any given period of time. All right, so if you are buying now, I'm talking about right now. If I want to buy, I'm going to pay more, and the person that is selling is going to receive more. The buying price is less than the selling price. All right. So it makes the investment less liquid. You would want to get as much when you sell your shares. You want to get a higher price, as high a price as possible. But at any given point in time, I'm not saying now that you're buying for a low price now. In future, that price can drop or it can increase or anything can happen. But right this very moment, any share right this moment has a buying price and it has a selling price. Both of those prices change over time, okay? But right this minute, if I want to buy shares, the price that I'm going to pay for those shares is higher than if I was selling my shares, I would have received a lower price. So you pay a lot when you buy the shares, but you receive less when you get your money out, okay, which makes them less liquid. All right, because you want your money back. Right, now we're going to look at ordinary shares. Right, I did refer yesterday to the fact that we distinguish between ordinary shares and preference shares, right? And that lesson is still coming. Okay, I'm only going to talk about ordinary shares now. Right, the advantage is that it is freely traded on the JSE. Remember, I did say yesterday that any company that wants to sell shares can do it on the JSE. Anybody that wants to buy shares can buy them on the JSE. You don't have to work through a broker. All right. Now, one of the very important advantages of buying shares is that you have limited liability. All right, what this means is you cannot be held responsible for the debts of that business. If I buy shares, let's say I buy shares for 100,000 Rand. I'm very wealthy and I buy shares for 100,000 Rand. Obviously, the business takes that 100,000 Rand and they use that 100,000 Rand to run the business. 10 years down the line, somebody makes a bad business decision, there's a recession, the company goes out of business, they are liquidated. All right. They have 7 billion Rand debt. Okay. Now, none of those creditors can come to me and say, hey, you're a shareholder of this company. We are now going to sell your house because of the company's debt. That cannot happen. Limited liability means that the only money that you are going to lose if the business is liquidated is the 100,000 Rand that you paid when you bought the shares. All right. So that money that you have invested in the company, you will lose that, okay, if they are liquidated. But they cannot touch your personal assets. All right. You are not personally responsible for the debts of that business. That is what limited liability means. That's an advantage. Right. As an ordinary shareholder, you have voting rights. Okay, obviously, remember I said yesterday, one share equals one vote. So if you have 10,000 shares, when they're having their annual general meeting once a year, which is compulsory by law, you as the shareholder are compelled to increase. You are supposed to attend, right? Not everybody does, but you are supposed to attend. And when they are voting on important matters, like, for example, they need to appoint a new director. You get to vote who that director is. If they want to vote on whether they're going to add another product to their product line, you get to vote yes or no. Are they going to build another factory? Yes or no. Are they going to take over their competitor? Yes or no, right? So as an ordinary shareholder, you get to have a say in the running of the company by voting at the AGM. Right, investing in shares normally also provides protection against inflation. In other words, the growth in the value of your shares plus the dividends that you are receiving, the return on your investment tends to be growing faster than inflation. All right, so the rate of return on your investment is higher than the rate of inflation. Okay, though that which you receive, the growth and the value of your investment increase faster than what inflation does. Right, investing in shares can also provide solid returns at retirement age. So obviously, if you buy shares now and you leave them and you forget that you have them, obviously you will get your dividends every single year if that company is profitable and if that company declares a dividend, you will receive your dividends every single year. Plus, at retirement age, you can also sell your shares if you so wish. That is long term. Over the long term, probably, maybe, the value of your shares would have increased. Short term, it doesn't always. Long term, mostly. Yeah? But anything can happen. Remember, there's always a risk that it doesn't. All right, the rate of return on your investment is linked to the performance of the company. The dividend that you receive once a year, you are, as an ordinary shareholder, you are only going to receive your dividend if the company is making a profit and if the board of directors decide to pay out the dividends. All right. If the company doesn't do well, if the company makes a loss, you are not going to have a rate of return. You will not be receiving a dividend. You only receive a dividend if they make a profit and if they decide to pay out that profit. Okay, but the better the company performs, if they make higher profits, obviously you get higher dividends. Right, ordinary shares are normally cheaper to buy than preference shares. Okay, so that's one of the advantages in terms of shares. If you want to have a cheap, relatively a more efficient kind of investment, near cost-effective investment, you buy ordinary shares instead of preference shares because they are a bit cheaper. And then obviously the more shares you own, the higher your dividend payout is going to be. Every one share is entitled to a dividend if they declare one. So if you've got 10,000 shares, you are going to get dividends for every single one of your 10,000 shares. All right. Your dividends is directly linked to how many shares you have. So the more shares you have, the higher dividend payout you will receive. On the disadvantages, as I said earlier, if the company profits are low or if they make a loss, you may not receive a dividend. A lower profit means a lower dividend, but no profit means no dividend. Okay, then there's no return for your investment at all. Right, and then companies have no legal obligation to pay dividends. Okay, there's not a law that says they have to declare a dividend. As I mentioned just now, it is totally at the discretion of the board of directors. The board of directors will look at how much profit was made and they will determine and decide if they're going to do a dividend payout or not. Even if they made lots of profits, there's no guarantee that they are actually going to declare and pay out a dividend. Right, the risk may be high. As I said, any investment in shares goes with a risk. Okay, share values can go up, share values can go down. Businesses can be successful, Businesses can be an utter failure and then you lose everything. Okay? Everything is a risk. Any time that you invest in shares, the risk is high. All right, and as I said, the dividends declared is determined by the directors. You have no control over that. It's up to them to decide if they feel like paying out a dividend or not. Right, the last investment that we are going to look at today is your fixed deposits. Right, first of all, on the advantage side, obviously your interest is earned at a fixed rate. Remember, we did say yesterday that when you make a fixed investment, your interest rate that you receive is fixed for the duration of the investment period. All right, so your interest is earned at a fixed rate, which means it is a dependable income and you know exactly what it is going to be. All right, it's not fluctuating with market conditions. It is fixed at the time that you make your investment. Right, the period of the investment can be over the short, medium, or long term. Obviously, this depends on the depositor itself. Now, the investor must decide, okay, am I going to do a fixed deposit for 2 years? Am I going to do it for 5 years? Am I going to do it for 10 years? All right, that is a decision that you make as the investor. So it is an advantage because you get to decide. Then the bank is not going to tell you, we only have a 5-year deposit. You choose how long the period you want for your investment period. All right, that's what I just said. The principal amount plus the interest is paid out on the maturity date. Okay, so remember with the government securities, we said that interest is paid out twice a year. And at the end of the maturity date, you get your principal amount back. With a fixed deposit, it works differently. All right, you put your principal amount away, you earn interest on that principal amount every single year, but you don't get the interest paid out every single year. You will, at the end of your investment period, if you've invested for 5 years, at the end of that 5 years, you will get your principal amount back that you've invested. Plus, at the end of that 5 years, you will get all the interest over the last 5 years' interest. You will get back when your investment matures. All right, so it's not a case of every year I'm going to receive the interest and I'm earning interest every year. You are earning interest every year, but you don't have access to that interest. That interest is not paid to you. All right, after the investment has matured and you get your principal amount back, that principal amount that you get back, it will include all the interest that you have earned over that investment period. All right, it ensures financial discipline because, as I said yesterday, there is no way in hell. Hell can freeze over. You will still not take your money out of that fixed deposit before the investment period has passed. All right, you absolutely cannot withdraw the money before that investment matures. So if you have invested that money for 5 years, it will stay there for 5 years. If you invest it for 10 years, it will stay there for 10 years. So it forces you to not touch your money. All right. It creates discipline because if you think about a 32-day deposit account, if I can just give notice quickly and in 32 days I take my money out, that's now more, I'm not saving then. I'm saving for shorter periods. This is discipline because I'm leaving my money there. I'm investing for a long period of time because I cannot touch my money before the time. All right, you also get a better return on investment than an ordinary savings account. Remember, I did say yesterday that the interest rate that you earn on a fixed deposit is higher than the interest rate that you will earn on a normal check account or on a normal savings account. All right, so the return on your investment is higher because the interest rate that you are earning per year will be higher. All right, now also very important to remember, the higher the principal amount, so the higher the money, the more money you're investing and the longer the investment period, the higher the interest rate they're going to offer to you. All right, so if you are only investing a small amount of money for like 2 years, your interest rate is going to be lower compared to a person that is investing a higher amount, like 20,000 Rand, for 10 years. All right, the more money you are saving, and the longer you are saving that money for, the higher your interest rate is going to be. On the disadvantage side, obviously I've mentioned this, now you cannot withdraw your funds before the maturity date. Even if you go and beg and plead and you tell them you do not have food to eat, they're not going to care. They're going to tell you you've got another 5 years to wait. In 5 years' time, you can eat. All right, you cannot withdraw your funds before the maturity date. Right, low returns compared to other investments. Okay, obviously we said the interest rate is higher than on a normal check account or a savings account, but it is lower interest compared to the government bonds. The interest rate there is higher. Dividends in successful companies tends to be higher. All right. Share values tend to increase over the long term, higher. All right. So the returns that you are getting, because it is a safe investment. Okay. Remember, a fixed deposit is also a safe investment, low risk, because there's not a good chance. Banks don't go bankrupt. Banks are not summa liquidated. It does happen once in a blue moon. It doesn't happen often. So it's a very low risk. And with a low risk, unfortunately, comes a low return also. All right, it may not outperform the effect of inflation over the long term. All right, so all the others that we were looking at today is good in terms of inflation. Okay, it increases faster than inflation, but with a fixed deposit, obviously it depends on the interest rate that you are offered for your investment. Okay, if your interest rate is higher than the inflation rate, then the disadvantage will disappear, right? But if if the inflation rate is higher than the interest rate that you are earning, your money is actually losing value over time. You are earning interest, yes, but when you withdraw that money after 5 years, the purchasing power of that money is going to be less because of inflation. All right. For this investment to have a return, to have capital growth, you actually have to make sure that the interest that you are offered is higher than the inflation rate. The only thing is, remember, your interest rate is fixed for the period of the investment, and inflation is going to change over that time. All right. So you might invest at a fixed interest rate of 7% when the inflation rate is 5%, which means it's a good investment. But now for the next 5 years, you are going to earn 7% interest, right? And over this 5 years, maybe inflation changes from 5 to 7 to 9 to 10 to 15. All right. Then your investment is actually losing money. All right. And this is impossible to predict with any kind of certainty what the inflation is going to do over the next 5 years. All right. We can make predictions for 2 years, maybe. All right. And even that, it's flawed, right? But if you fix your interest rate at a time where inflation is low, and over time now that inflation increases, you will not outperform the effect of inflation. Your money will be losing value in time. When you withdraw that money, your purchasing power will be less.